Is your beverage business ready for 2026? In the UAE, excise tax has officially evolved. It's no longer about the price tag, it's about what's inside the bottle. From the 75% rule to new volume-based tiers, the stakes are higher than ever. Here is how to stay compliant and protect your margins. The biggest change: tax is now volume-based, not a percentage of the retail price. Whether your drink is premium or budget, the tax depends on two things: your sugar density per 100 milliliters and the total liters you sell. More sugar means more tax, period. Here is the technical twist. Artificial sweeteners are ignored unless you add any amount of actual sugar. Once you add real sugar, the natural sugars in the drink are also taxed. The 2026 tiers: under 5 grams sugar, exempt AED 0, 5 grams to 8 grams, AED 0.79 per liter, 8 grams or more, AED 1.09 per liter. Note: purely artificial sweeteners remain at zero tax. Need a tax-friendly strategy? The 75% milk threshold. If your drink is at least 75% milk, it's a dairy product and usually exempt. Drop below that 75% mark and add sugar, you're back in the taxable zone. This one rule can save your business thousands. Compliance isn't optional, it's documented. Lab certification from an FTA-approved UAE lab is mandatory for product registration. Without a lab report, the authorities will default your product to the highest sugar band. It's not just a recipe, it's a legal requirement. Don't let the excise portal or lab requirements slow you down. At Tulpar Global Taxation, we handle everything from lab coordination to final submission. Reach out today, get your products registered correctly, and stay ahead of the 2026 regulations. Subscribe for more UAE tax updates.